Investors in the banks will not be protected. They knowingly took a risk, and when the risk didn't pay off, investors lose their money. That's how capitalism works.
Hey, welcome to About That. I'm Kieran, Oudshoorn, sitting in for Andrew Chang. Now, that was U.S. President Joe Biden saying that investors in Silicon Valley Bank are SOL when it comes to protection for the second largest bank collapse in the country's history. And in case you missed it,
the collapse of Silicon Valley Bank is causing shockwaves across the entire business world.
Silicon Valley Bank, SVB, is part of the tech establishment.
Silicon Valley Bank's collapse set off a panic.
Up until last weekend, Silicon Valley Bank was a commercial bank in the U.S. It served mostly startups and tech companies in California, and it collapsed pretty dramatically on March 10th when it was shut down by the Federal Deposit Insurance Corporation, or FDIC. That's the government agency that oversees the banking industry. And the shutdown has a lot of people very worried.
If you have $1 in a U.S. bank right now, you must listen to this message.
One of the biggest banks in America just collapsed.
Okay, so how did this happen? And why is it causing so much concern? Well, in order to understand what took SVB down so fast, we should start at the most basic level. What does a bank do with the money that you put in it? Well, you make a deposit, the bank can lend that money out, and they earn interest on it and make profit. But the bank has to hold on to a certain amount of those deposits, its reserves, so that you can take money out when you want to. Now, the U.S., they're able to hold maybe 10% of the deposits that are usually sitting there. So that's 10%, which is sitting in reserves. And the thing is that not everyone can take money out at the same time. Like I said, they're only holding on to 10%. And some of these smaller banks, they don't have the same amount of deposits in cash. And that's where everything went totally wrong for SVB. Now, remember, I mentioned that it funded mostly tech startups and companies like that. Well, they were raising a ton of money during the pandemic, and then they dumped most of that money into the banks. But they haven't been doing that great over the last year.
Tech stocks have had a rough 2022, but can the sector turn it around in the new year? Well, joining us now, Rohit Kulkarni from MKM Partners. Rohit, can big cap tech turn it around next year?
It's going to be tough.
Because of the soaring interest rates, those companies are having a harder time raising capital. For a lot of them, they've seen their companies tank in value. So they've been taking out more and more money from the bank to cover those costs. And it's meant that banks like Silicon Valley have been getting short on cash themselves. So short that they've had to sell some of their assets at a loss. Now, let me explain. SVB had taken out a lot of money that the tech companies had been depositing during the pandemic, and they bought long-term bonds, which is totally legit and is usually a pretty good idea. Lots of banks hold on to treasury bonds because they're a pretty safe investment in the long term. They're basically loans from citizens to the U.S. government, and they're easy to sell if you need money. But the thing about the bonds is that when interest rates drop, the value of the bonds increase. And when interest rates rise, like they have been, those bonds' value decreases. And so SVB, well, they bought a lot of those bonds when interest rates were at historic lows. So they were really expensive. And now, well, we all know what's been happening in the last year. We've all seen the interest rates skyrocketing, which has lowered the bond prices. So when SVB was forced to sell their bonds at a loss, it took a big hit. Then it announced that it needed to raise more than $2 billion to keep up just with withdrawals. And that's when investors and venture capital firms really started sweating. Now, venture capital funds started advising their tech companies and startup clients to take their money out of the bank, which caused a panic and led to a run on the bank. That's when everybody goes to pull their money out at the same time, or at least tries to. And those reserves that I mentioned earlier, well, they're gone, no longer there to cover the wave of withdrawals.
This was a run on a bank with a difference. In Silicon Valley, not regular customers of a high street bank, but tech firm CEOs here, startup bosses, desperately seeking their cash.
They just came out and told us that the bank is shut down.
So SVB made the announcement last Wednesday, and by the end of Thursday, just a day later, customers had withdrawn a whopping $42 billion of deposits from the bank. and the bank had a negative cash balance of $958 million. So its stock sunk, and the regulators, well, they shut down the bank.
The FDIC has now put out a release with regard to the now wind down of Silicon Valley Bank. In their news release, the FDIC rather says that Silicon Valley Bank Santa Clara was closed today by the California Department of Financial Protection and Innovation. A receiver bank has been now set up to basically take over all of the operations of Silicon Valley Bank.
And all that chaos, it sent shockwaves through the financial markets and right around the world.
Concerns growing over the stability of what was a tech-focused lender in the Valley. Many called it the backbone of Silicon Valley. It lost nearly $2 billion selling assets following a greater than expected decline in deposits. But here's the problem. Venture capitalists reportedly advising their portfolio companies to pull their money from the bank. Those concerns, of course, rippling through the banking sector.
Okay, so it's still pretty early to say exactly how all this is going to play out. But here's what we do know. Unlike the government's response in 2008, the U.S. says that it's not bailing out SVB. President Joe Biden said that the lost deposits will be covered by insurance and that the clients will get their money back. So to talk about the wider implications of all this, my colleague Lauren Bird spoke with Ray Wong. He's the CEO of a Silicon-based consultancy called Constellation Research.
Hi, Ray.
Hey, how you doing?
I'm doing good. How are you?
Pretty good.
So tell me, how did we get to this point?
Yeah, you know what's interesting is low interest rates for a long period of time, an IPO market dearth, right? There was 151 IPOs in 2021. That's 10x less than the 1035 we had the year before. I mean, that's how crazy it's been, right? And just that IPO dearth has been increasing. I mean, it's like a focus on high tech, on biotech, right? Suddenly come crashing, and then the interest rates came up so quickly.
Right, so it all just happened kind of very quickly. So, like, how does this really compare to other bank collapses that we've seen? I know we were saying it's the second largest one in U.S. history.
Yeah, this one is because it's highly concentrated, right? Silicon Valley Bank was focused on high tech, biotech. Their founders and investors would bank with them. They do their personal loans there, their mortgage loans. So this was a big one to come down. And it really was coming down to the fact that unrealized losses, right? You get a sudden interest rate hike. You've got a lot of money sitting there, and people bought long-term bonds thinking that that would be safe, not realizing that interest rates were going to keep going up. And when that happens, your interest rates are, much lower than what the outside interest rates are when you cash out, and you end up creating these losses.
So what happens then to people banking here and to companies banking here?
Well, the challenge was in this era of crisis of confidence, what happened was people no longer trusted the leaders. So when a bank CEO comes out and says, oh, everything is fine, don't worry, it'll be okay, people actually react in the opposite direction. You add social media to that, and actually what happened was a run on the bank. So even if everything was fundamentally correct at the bank, the run on the bank already occurred, and there's not much you can do once a bank run has occurred other than for the federal government to step in to help out.
Do you think social media really played into that in a big way?
Social media played largely into this. What we saw was Peter Thiel, we saw the Y Combinator folks, we saw the VC piling on social media saying, hey, you better get your money out very quickly. And we started hearing this on Wednesday, and then we started hearing even more on Thursday. And by the time it hit Friday, a lot of people had already gotten enough money out of there, almost 48 billion in terms of orders. I mean, banks don't keep more than 10% of what their deposits are on hand.
Right. So are we going to see this expand into other banks? Is there going to be a knock-on effect here?
Well, hopefully the Fed has controlled the contagion by saying, look, all the losses, including the ones above $250,000, will be protected. The challenge is we also have a lot of regional banks that might be in that situation and smaller banks. What we don't want to be is in a situation where there are only 4 large U.S. banks that are left. Think about that. That would just be Citi, Chase, Wells Fargo, and Bank of America left in the mix. And the smaller banks play a huge role in terms of regional business, helping out with auto loans or helping out with banking, advice, or helping out with, things that you normally wouldn't see in a larger bank, a different level of service. That's what's going to be missing.
Right. And when we're talking about bailing the bank out. I mean, U.S. officials have said that's not going to happen this time. What's that going to mean?
I'm not sure what the difference is between a rescue and a bailout here, because it's certainly to look like a bailout from this perspective. But if you can guarantee that the assets are there, but you need someone else to pick up the bank at those assets for this to work. So some larger bank will actually have to acquire these assets. Otherwise, it's the government really bailing it out, or the FDIC paying out the insurance premium on the lost assets.
Wow. It's going to be interesting to watch for sure. Ray Wong, thank you so much.
Hey, thanks a lot.
So we have a sense of what's happening in the States, but what about the implications here in Canada? Experts say that the impact won't be huge, but it will be felt in the venture sector.
That's effectively stopped investment. And so we're very concerned that the whole ecosystem, is at some meaningful risk.